Assalamu alaikum everyone. Yesterday, we left the class with the June 2013 question number 1. So please kindly keep the hard copy of the June 13 question number 1 in front of you. I'll not be displaying the question on the screen because I need to use the Word file. So everyone keeps the June 13 question number 1 we were discussing in the class yesterday as the first question on the audit risk topic we started yesterday. Okay, now in the class yesterday, when we were talking about the June 13 question, I was using this Word file and we came to a conclusion that there are 6 marks for analytical procedure in that question. There are 5 marks for additional information in that question. And there are 13 marks for the audit risk in that question, right? We segregated that marking scheme yesterday. Now, I have shared the answer on the WhatsApp group. I hope all of you have got the PDF version of the answer from the WhatsApp group for the P7 classes. Is everyone having the PDF version with them? Now, if I look in the answer, okay, I put the file on the TSA group, which is basically the class group, the normal class group. Is that with everyone? Okay, irrespective of that, I'm putting the answer on the screen, right? Because I think yesterday I attached the file after the session end and that was delivered to everyone. No idea whether you have checked the WhatsApp group or not. I'll check on my end, right? If it is a problem at my end, so I'll resolve it. Okay, if I just go down quickly, and we were doing this question yesterday, so let's put it on the screen. Yes, exactly. There are 2 groups, right? One, there are 2 groups on which you might be. I think I've posted it on any one of the group. Either that's the evening batch group or the normal group, which consists of morning and evening batches. Okay, irrespective of that, let's put the question on the screen we were discussing yesterday. I've shown you the format of the briefing note yesterday, right? We did the format of the briefing note, right, from the start to the end. And I've shown you the answer on the screen, right? So I'm putting the same answer on the screen. This one. Okay, so the very first thing we need to do in this question is perform the preliminary analytical review. And we decided yesterday that we have 6 marks for performing the preliminary analytical review. And we'll do 6 ratios, right? 6 ratios for 6 marks. And that was very clear yesterday that you just need to show the ratio. And just by showing the ratio, you will get 6 marks, right? No commentary on the ratio, only the ratio and 6 marks. Now, if you look at my answer plan here, see under the heading of the introduction, which we decided yesterday, see my first heading. My first heading is results of analytical procedures. And under the heading of results of analytical procedure, I have put the 6 ratios: gross profit margin, net profit margin, interest cover, current ratio, receivable collection period, and inventory holding period. And in front of that, there are 2 columns, 2013, 2012. Obviously, you will find the answers and you will write the answers. I'll not be doing that because this ratios has to be taken out by the students, right? Whenever you get time, please find the answers of the ratios and put the answers of the ratios on this file once you get the file in hard copy. But see this, the 6 ratios on the screen, you put the 6 ratios and you get 6 marks. So how simple those marks are. So examiner is saying perform the analytical procedure. So perform means to show the ratio. So once you show the ratios, you're taking 6 easy marks in this question. right? So Sayyid Faraz Hassan, we just started to discuss the question we were discussing yesterday. So the very first thing we decided we should do today was the first requirement of the question we were doing yesterday, results of analytical procedures. So I was just telling the class that the results of the analytical procedure has to be shown like ratios, and 6 ratios means 6 marks, right? So is everyone clear with this? 6 ratios and 6 marks. So they are very simple marks to get in the exam context. Okay, now once you have done the 6 ratios with 6 marks, any 6 ratios, right? Any 6 ratios you want to do the 6 ratios and take your 6 marks. But please don't waste time writing the formula of the ratio. That is a waste of time in exam. Don't waste time writing the values of the ratio. Just on your calculator, find out the gross profit margin and write the answer of the gross profit margin in 2013 and write the answer of the gross profit margin in 2012. Try saving your time. You have 6 marks. So 6 marks means you have 12 minutes, 1, 2. So within 12 minutes, try to find out the answers and write them down. Okay, is everyone clear till that point? Results of analytical procedures, how to put them? Okay, the second thing the examiner wants us in that question was to evaluate the audit risk. So I'm now starting an exercise, which is the basic purpose of the class today, is to understand how to identify audit risks from the case study. And I hope all of you have read the exam paper. I mentioned that yesterday, that I assume you have read the case study. So honestly, all of you have read the case study? Okay. Muhammad Amjad, yes, I'll share the video link, the lecture link with you for the class yesterday, because obviously in the current days, my schedule is very much occupied. So once I get free, most likely by tomorrow or day after tomorrow, I'll share the links of all the classes, Monday, Tuesday, Wednesday. Okay, let's start an exercise on audit risk, and let's put the question in front of us. We were doing yesterday the audit risk question. Okay, so we started with this question yesterday, right? June 13, question number 1. And we have to discuss the audit risk, right? Okay, let me open the comment box so I can illustrate the answer. Okay, so what we have to do here, we have done the analytical procedures, right? We have done the analytical procedures, crossed. Okay, now the second thing we have to do is evaluate the audit risk, And yesterday we found we have 13 marks for audit risk. Every risk is worth 2 marks. Now, how you find audit risk from a question? How you find audit risk from a question? Let me illustrate you that. If I go back to the audit file, please, I'm doing audit risk understanding for the one and last time. So I'll try to put maximum time on understanding audit risk today so that you have no ambiguity on audit risk. Now, in a question on audit risk, or in a question on ROMM, because both of them are more or less the same. So in a question on audit risk or ROMM, how to identify the audit risk? How to identify the audit risk, or how to identify the ROMM? Is there a technique? Yes, there is a technique. Now, when you're reading a case, how will you get to know from a case that there is a risk? How will you identify a risk? Because if you don't know to identify risk, then obviously you will not be explaining it. So let's see how you identify a risk from a case study. When reading a case, you can find ROMM or audit risk from three sources, which are as follow. The first source from where you can find the risk when you're reading the case is the risk will come from the journal statements given in the case. Second, I'll tell you what journal statements are, right? Secondly, the risk will come from the accounting treatments. Now, yesterday we had a word on this, that something reported and something required. The difference is the risk. So in an exam paper, you have to be very critical of an accounting treatment. If you think the accounting treatment is wrong, then there is a risk. So you have to be very critical of an accounting treatment when you're reading the case. And the third source of risk is numbers. Obviously, the auditor analyzes the numbers, right? Because by analyzing the numbers, you can find an unusual fluctuation. Or by analyzing the numbers, you can find implausible relationships. And in every question one, examiner will give you the financial statements, whether they are summarized financial statements or they are the full financial statement. But no question one will be without numbers. In every question one, you will find numbers, whether less or more, right? So the numbers have to be taken very carefully because there might be some risk within the numbers as well. So when reading a case, there are three sources of risk. I'll do an exercise with you, and hopefully by the end of the class, you will be clear on this. Three sources, right? Three sources. Okay. Now, when I look at the case, which I have to read today with you, let's read the case and let's see what is the scenario. If I start reading the case from the top, it says, you are a manager in Hound and Company, responsible for the audit of a Parker company, a new audit client of your firm. So in the very first line, I'm getting the very first risk, a new audit client of your firm. So Hound and Company is a new audit client of our firm. Now, obviously, new audit client has nothing to do with an accounting treatment, but I'm finding the first example, new audit client. I'll convert that to the risk once I start the exercise. So we'll see how a new audit client can be an audit risk, or how a new audit client can be a risk of material misstatement. Okay, let's continue after. A new audit client of your firm. You are planning the audit of the Parker financial statement, and you have just attended a meeting with Ruth, the finance director of Parker, where she gave you the projected results for the year. Obviously, at the planning stage, you cannot get the final results. So at the planning stage, we get the projected results, also known as the draft results. So that is nothing shocking. Rather, that is something very natural, that at the planning stage, we cannot get the final results of the company. So the results are either projected or draft. Parker Company designs and manufacture health and beauty products, including cosmetics. And then after that is the email of the partner. Now, ignoring the email, I go down and I look at the profit and loss account of the company. Now, when I look at the profit and loss account of the company, you can see the note number 1 in the profit and loss account. The note number 1 relates to cost of sales. The note number 1 relates to cost of sales. The examiner is explaining the note number 1. Let's see, is there any problem in the note number 1? The examiner is saying in the note number 1, cost of sales includes $250,000 relating to a provision for a potential fine payable. Can we include the provision for fine payable in a cost of sales? Is that the right accounting treatment or wrong accounting treatment? No. So this is a wrong accounting treatment, right? We cannot include the provision for fine payable in the cost of sales. Where we should put it? Where we should put it? We should put it in operating expenses, right? So what's the first risk? The first risk is the wrong classification. Wrong classification. We have classified the fine, provision for fine, in cost of sales. Now, if I've included the provision in the cost of sales, my gross profit must have been distorted, right? The Advertising Regulatory Authority has issued a notice of a $450,000 fine. How much was the amount of fine? No. Because the company has recognized a provision, so that means the company knows it has a probable outflow. So we're not worried about being a contingent liability. Obviously, cost of sales includes a provision. So if the management has recorded a provision, that means it has a probable outflow. But they have recorded the provision in the cost of sales, which is wrong. They should have recorded the provision in operating expense. What is the total amount of provision? Total amount of fine? $450,000, and we have recorded the provision with. $250,000. So is the provision under recorded? Is the provision under recorded? Yes or no? Yes. By how much? By $200,000. So if the provision is under recorded by $200,000, so is the current liability understated? Is the current liability understated? And is the operating expenses understated? Operating expense understated. And the profit is overstated. So if the management has recorded the provision with less amount, what will happen? Yesterday, remember the class yesterday? Impact on an account balance or impact on the financial statement. So when the management has recorded provision with a less amount, so current liabilities will be understated, profit will be overstated, expense will be understated. So see the note number 1. So note number 1 is a wrong accounting treatment. So I go back to my Word file, and in my Word file, because I'm trying to tell you that the risk can come from 3 sources. The first risk came from a new audit line. The second risk came from the wrong classification of a provision. The provision was wrongly classified in cost of sales. That was one risk. And the second risk was the provision was under recorded by $200,000. Thus, expense is understated and profit is overstated. Is everyone clear so far? So firstly, the provision was wrongly classified, and secondly, the provision was under recorded by $200,000. Thus, expense is understated and profit is overstated. That is something we learned yesterday, right? That we need to write an impact on an account balance. So is everyone clear so far? 2A, 2B. Please, I need your spontaneous yes and no so I can keep the pace of the lecture. Okay, fine. Okay, let's go back to the PDF file. Okay, I'm going to the page 2 now. There was only note number 1, right? So I'm going to the page 2 now. On the page 2, I can see the balance sheet of the company. And in the balance sheet of the company, there is a note 2. And the note 2 relates with intangible assets. The note 2 relates with intangible asset. Development cost. How much is the value of the development cost? 2250. Now let's see what is happening in the note 2. If I go down and I see the balance sheet for note 2, there is also a note 3. The note 3 relates with revaluation reserve. So there are 2 notes, right, in the balance sheet. One note relates with intangible asset development cost, and one note relates with revaluation reserve. Let's see what is wrong with both of them. Let's go down and find the answer. The examiner is telling in the note 2, development cost relates to a new range of organic cosmetics. The moment I see the word development cost relates to a new range of organic cosmetic, the company has capitalized the development cost. The company has capitalized the development cost. So is there an accounting standard here? Which accounting standard? The development cost relates to new range of organic cosmetic and the company has capitalized the development cost. Which accounting standard should I refer to? IS 38, right? The IS 38 tells us that the development cost should be capitalized subject to a criteria and the research cost should be expensed out. Now the management has capitalized the development cost. The development cost relates to new range of organic cosmetics. So if I go back to my Word file, I am finding an accounting treatment. Number 3, development cost, and development cost means IS 38. Now we are finding a risk. What is the risk? The company has capitalized the development cost and there is a silence by the examiner. The examiner is not telling me anything. What will I think in the exam hall? How will I be skeptical? How will I think negative? The company has capitalized the development cost, which seems to be right. But how will I be negative? How will I be negative? How will I find the risk? Something reported and something required. Okay, criteria not met. Criteria not met. Risk that the conditions might not have been achieved. Exactly. So the management has recognized the development cost as an intangible asset, something reported and something required. Currently on the face of it, it looks fine, but there might be so many risks. What if the criteria has not been met and the management has capitalized the development cost? Is that true? Even yes, agree, Khwaja Ukasha, that the management has included the research cost as a development cost. So development cost has been capitalized. So in the exam, I have to think negative. So if I think negative, what if research cost was included as part of development cost? Or what if the research cost was also capitalized? Can that be negative thinking? What if the research cost has been capitalized? What if the criteria was not met? The criteria was not met. Can this all be the negative thinkings? What if the management has capitalized the development cost when the criteria has not met? What if the management has even capitalized the research cost? So you cannot think positive. How will you find a difference? Remember the definition yesterday? It's the difference between something reported and required. Can we trust management for whatever they have reported? Can we trust management for whatever they have reported? Answers. Can we trust management for whatever have they reported? No. So should we be skeptical about management or not? We should be skeptical about management, right? So is number C clear to everyone? Though the question is telling that the development cost has been capitalized, as per a student of accountancy, that is perfect. But I have to be skeptical. I have to think, what if the criteria was not met and the management has still capitalized it, right? So is that another risk? Is that another risk coming from the accounting standard, development cost? Okay, let's go back. Number 3, note number 3, right? Note number 3 relates with another accounting standard. This time it says all of the company's property were revalued on the 1st of January by an independent, professionally qualified expert. Properties were revalued. Which accounting standards? Which accounting standard? Property were revalued? IS 16, right? See when you read the note 2, examiner is just giving you a sentence, right? And in the sentence, you can pick the accounting standard. In the sentence, you can pick the accounting standard. Development cost help you with picking IAS 38. Revaluation help you picking the IAS 16. Now you have to think negative. You have to think negative. Properties were revalued. Properties were revalued. Okay, fine. Properties were revalued. That's something good as per IAS 16. Think negative. Who will think negative? What will be the negative thinking? Who has done the revaluation? Who has done the revaluation? The management or an expert? Who has done the revaluation? The management or an expert? Expert. So who is an expert? Expert is independent. An expert is qualified. I hope you remember the block one. Block one, we did a topic using the work of others. So expert is qualified. Can I trust him? Yes. Expert is independent. Can I trust him? Yes. So can I use the work of an expert? Can I use the work of an expert? Yes, because the conditions you learned in the block one of the syllabus have been adhered to. Then what is the risk? The properties are revalued by an expert. He is independent and he is qualified. No, that is a different story, Khwaja. That is a different story. Currently, we are at the planning stage. So we're not worried about it. What is the risk then? The management has not done the revaluation. If the management would have done the revaluation, I would have been skeptical whether they have taken the right assumptions or not. Okay, skeptical about what? What if the depreciation, what if the depreciation charge has not increased? Will the depreciation charge increase post revaluation? What if the management is charging the depreciation on the old book values? See, something which will be done by an expert will not be wrong. Something which will be done by the management will be wrong. So revaluation has been done by an expert, but the depreciation has to be charged by the management. What if the management charged the depreciation on the old values rather than on the revalued amount? So will the depreciation charge increase? And what if the depreciation charge has not increased? Will that be a risk on part of the management? If the depreciation charge has not increased, expense will be understated. Expense will be understated and profit will be overstated. Is that true? Second, what if the disclosures are not given? Are there any disclosures of revaluation? What if the disclosures are not given? Do IAS 16 requires any disclosures of revaluation? Because disclosure will not be given by an expert, right? Disclosures will be given by the management. So management can do something wrong. What if the disclosures are not given? Disclosure of what? Disclosure of the class of asset revalued, the class of asset revalued, the date of revaluation, and disclosure of the assumptions used in revaluation. IAS 16 requires a disclosure, right, of the revaluation. What if the disclosure are not given? So what will happen? Something will be understated and overstated? Something will be understated and overstated? No. Financial statements could be materially misstated. See, I didn't criticize the reserve because the reserve was created by the expert. I criticize something which the management will do. Now, the management will ideally do the depreciation, so there can be a risk in the depreciation, or else the management will put the disclosures, so the risk can be in the disclosure. right? So something done by the expert, I didn't criticize that, but something done by the management, I'm criticizing it. Is everyone clear with the point number D? Monis, can you rephrase your question? I cannot sense your question, what you're trying to ask. Can you rephrase your question again? Yes, agree, Khwaja. Disclosures are there, but not appropriate. There can be both no disclosures or disclosures are inappropriate. Numan, we were discussing in the point D that the properties were revalued by an expert, right? So if the expert revalues the property, there is no risk. But obviously, the revaluation has been done by an expert. But the depreciation after the properties have been revalued, the depreciation charge will increase. So what if the depreciation charge is not increased? It will create a risk. And secondly, what if the management has not given disclosures of the assets revalued? Then the financial statements could be materially misstated. Monis, no, we cannot put that. We cannot do that. Headings, I'll just show you the headings. The headings have to come from the case study. The headings would be revaluation. Under the heading of revaluation, I'll write my answer. I cannot give headings like such, which you are saying, Monis. Okay, Muhammad Amjad, agree with your answer. Perfect. If you want to write that, you can write that. Hasnan, perfect, agree with your answer. Yes, we can write that. Okay, so far we have done 4 under the accounting treatment. Wrong classification, the provision was wrongly classified. Development cost, we have to think negative. Properties were revalued, negative thinking. Okay, let's go back. Okay, let's start reading the case from business review. I'm reading under business review, right? Business review. Parker is facing difficult trading conditions. Consumer spending is depressed due to recession in the economy. The health and beauty market remains very competitive, and a major competitor launched a very successful new cosmetic range during the year, which led to, I hope you remember my lecture, Implausible Relationships, which led to significant decline in sales of one of the Parker most successful brand. The competitor has launched a very successful new cosmetic range, which has led to a significant decline. Examiner is not saying decline. Examiner is saying significant decline in sales of one of the Parker most successful brand. Most successful brand means the major income generator. How would I find the implausible relationship? Go to the income statement and find how much sales have gone down. Go to the income statement and find how much sales have gone down. How much is the percentage decline in sales? Income statement, right? Income statement on the page number 1. See how much is the decline in the sales. No, decline is taken in percentage form, right? 8% is a decline. So do you agree that 8% decline is plausible with the underlined word here, which led to a significant decline in sale of one of the Parker most successful brand? Do you think this line and the 8.2% decline is plausible or implausible? Do you think the decline should have been more than 8.2%? 8% is not a significant decline, right? So do you believe the decline should have been more than 8%, like 20%, 30%, for example? So can we say the revenue is overstated? Can we say the revenue is overstated? Right? Now, this is a very good example of something we were doing yesterday, or rather on Monday, implausible relationship. Now, the examiner was saying led to a significant decline. Led to a significant decline. So, see how we found a point. This is the first point we are finding under numbers. Under the numbers, right? This is the first point under the numbers. Significant decline versus 8.2%. Thus, this is implausible and the revenue could be overstated. Yes, but that is very far away thinking, Muhammad Amjad. Your thinking is fine, but that's like too far away. But is everyone understanding the 3A? Significant decline was given in the case, and 8.2% is what you found out. And all of you agree with me that this is not an implausible relationship. Thus, this is implausible, and revenue could be overstated. Is everyone clear with the point 3A? Is that a risk? So risk coming from the numbers. So you have to be very clever when you're reading the case. Okay, another very important thing. Okay, I'm reading from the third line again. It has been necessary to cut prices. It has been necessary to cut prices on some of the company's product range to maintain the market share. If the company cuts prices, selling prices, cut prices, what is the risk? See, I want to see how far can you go. If the company is cutting prices of some of the company's product ranges, cut prices. If you are an auditor, if you are an accountant, how would you justify the cut prices? Muhammad Ali, there is no percentage benchmark because we just need to justify something is being under and overstated, right? Firstly, I cannot understand your question, Muhammad Ali. And secondly, there is no percentage benchmark to evaluate it is under, overstated. No one is reaching the right destination. Cut prices on some of the product range you are selling. What about IAS2? Inventory valuation, lower of cost or net realizable value. Cut prices. IAS2, inventory valuation, lower of cost or net realizable value. There is an economic recession. There is an economic recession. Is there a risk? There is a risk that in economic recession, the NRV can be lower than cost. Cut prices. Cut prices is bringing a risk on the net realizable value. You're getting my point or not? You are all accountants. Cut prices, net realizable value. There is an economic recession. There is an economic recession, right? In the economic recession, there is a risk that the net realizable value can be lower than the cost. In the economic recession, there is a risk that the net realizable value can be lower than the cost. Will the management, what is the benefit of the management? Management overstate the inventory or understate the inventory? Overstate. So when there is a cut of prices, should the auditor be skeptical when he goes for the audit? Will the auditor confirm whether the NRV is higher or NRV is lower than the cost? So should I be skeptical on cut prices? Should I go back to my Word file, cut prices? Cut prices of products, the products I'm selling, cut prices of products brings a risk on NRV net realizable value, IS2, inventory should be valued at lower of cost or NRV, and because of the economic recession, you have cut the prices. And this is very true in economic recession, right? Economic recession, cut prices. So what's the risk? The risk is that NRV could be lower than cost. And if the management value inventory at higher of cost or NRV, higher of cost, negative, right? Not lower of cost, higher of cost. We're thinking negative. Higher of cost or NRV, inventory could be overstated. See, are you getting the sense of the point E? Is everyone clear on the point 2E? How we found the cut prices and linked that to IS2, whereas all of you were thinking about cut prices and sales. Cut prices, you're all accountants. Cut prices, such an important point for net realizable value. So will you remember that for your other questions to come? Cut prices, you have to link your IS2. You have to link your inventory valuation. Is everyone clear on that? Please, you have to think negative. You have to think negative because that's the only way you will find risk. If you think positive, you will never find risk. So negative thinkings, right? Be skeptical, think negative. That is the only way you will find risk. Risk will be coming out of what if analysis. So the more what if analysis you do, the better. The more what if analysis you do, the better for you. Is everyone clear with the cut prices? Can I continue after? Muhammad Amjad, Khwaja, Hasnain, Monis, Numan. Is everyone clear? So see the thought process. No, Hasnain. Or else agree, Hasnain. You can agree with that. Okay, let's go back to the case. So tell me one thing, that the management has capitalized a development cost relating to the new range of organic cosmetic, right? As per ICE 38, one of the condition to capitalize the development cost is the future economic benefits. If even the organic cosmetic gets ready, will I be able to sell it because there is an economic recession? I hope everyone understands development cost should be capitalized subject to a criteria. And one of the criteria to capitalize a development cost is that I can generate the future economic benefits. But when there is an economic recession, even if I make the new organic cosmetics, how will I sell it? Will the sales be prosperous? Yes, the recession brings a question mark on the future economic benefit from the new range of organic cosmetic. So does that brings a risk? Does that brings a risk on the condition of ICE 38? And does that brings a risk on the capitalization of the development cost? So should I be skeptical the development cost should be capitalized or not? Economic recession is a big question mark here. And the economic recession is bringing a question mark on whether the development cost should be or should not be capitalized. All of you agree with my point of concern here? So future economic benefit, right? So even if I'm recording an intangible asset, I need to record an intangible asset when the cost can be measured reliably and there are future economic benefits. But I cannot see the future economic benefits here. So can I link this point with my ICE 38 point when I'm writing the ICE 38 in the answer? Okay. Continue. Financial matters. Cash flow has been a problem this year, largely due to cash spent on developing the new product range. Is that another condition of IS 38 to capitalize the development cost, that you have adequate financial resources to complete the ongoing development? You have adequate financial resources to complete the ongoing development, else you cannot capitalize the development cost. Is that another condition of IS 38, that you should have adequate financial resources to complete the ongoing development? Students need your answers. Yes, think so. Monis, start revising your accounting standards. Start revising your accounting standard. Okay, Sayyid Faraz Hassan is helping, telling that there is a mnemonic known as pirate. Pirate is the mnemonic for conditions. Conditions of IS 38, Sayyid Faraz Hassan. Pirate is the condition, is the mnemonic for conditions. Sayyid Faraz Hassan, can you just spell out pirate? What is pirate for the benefit of the rest of the class? Can you put it in the chat window so I can share it with the rest of the class as well? So is there a risk on the development cost which has been capitalized? Firstly, because there is an economic recession and I cannot expect the future economic benefits. And secondly, cash flow has been a problem this year. What if I have inadequate cash to complete the ongoing development? So if I have inadequate cash to complete the ongoing development, should I capitalize the development cost? No. Okay, so cash flow has been a problem this year, largely due to the cash spent on developing the new range of products. Cash was also needed to pay the dividends to both equity and preference shareholder. To help reduce the cash flows, some new assets were acquired under the finance lease. Finance lease. Now, this is a very old question. This is an old question when we used to have an IS 17. Now you have IFRS 16. This is the June 2013 paper, when we used to have IAS 17. Yes, due to development, right? Due to development, there had been a cash flow problem. But what if I have inadequate cash to complete my remaining development? Obviously, development is a huge drain of resources. Development is a huge drain of resources, Khwaja. So it could be possible that I have completed my 50% development, but now I don't have any cash further. So I have to be skeptical about the remaining development. If the remaining development can be completed, then I can capitalize it. Okay, Sayyid Faraz Hassan, thank you for that. I'll be sharing that with the rest of the class. That's good enough even for the rest of the class to know, and then link to the case study. Okay, so finance lease, right? This question is June 2013. At that point in time, you don't have the IFRS 16, you had IS 17. So at that time, the examiner wrote in the answer, what if the lease was wrongly classified? But now we know under the new IFRS 16, all leases have to be treated as finance leases, unless and until the lease has a life of less than 1 year. Right now, under the new IFRS 16, there is no issue of an operating lease and a finance lease, right? There is only one option, that you have to recognize the lease as a finance lease. So I'm just ignoring the lease point because it relates to IAS 17, which has now been outdated. In this question, the nature of using the finance lease was to hit the IAS 17 operating lease, which is not the case now, right? Yes, Hasnan, perfect, agree, you can write that. Okay, and the extension of a bank loan, was negotiated in December 12. So see, the company has mitigated the cash flow problems. the cash flow has been a problem, but they got a loan. The extension of a bank loan was negotiated in December 2012. So has that mitigated the cash flow problems? Has that mitigated the cash flow problem because they've got a bank loan? Yes. So the only problem now is the economic recession, right? The only problem now is the economic recession, because the cash flow problem has been mitigated. So we cannot be skeptical on that now. The company negotiated the bank loan. When examiner is telling us the date, is there a specific reason why the examiner is telling us the date of the loan, December 2012? What is the year end of the company? What is the year end of the company? Quick, 30th June, June 13. And when the loan was taken? Yes, yes, Khwaja, agree. Yes, we should not be. We should not be. The company's year end is June 13. We look at the current year, right? Monis, not the prior year. So they have taken a loan during the year. They have taken a loan during the year. The year end of the company is June 13. So they have taken a loan during the year. That is halfway through. If the company has negotiated a loan during the year, is there a risk of creative accounting in the financial statement? If the company has negotiated a loan during the year, is there a risk of creative accounting? Will they window dress the financial statement to take a loan from the bank? Will they or will they not? If the company has negotiated a loan during the year, they must have manipulated their financial statement to show a better performance. They must have manipulated their financial statement to show a better performance. So is there a chance that the loan they have negotiated must have created a risk of creative accounting in the financial statement? And obviously it is in recession. I hope if you remember the block one, in the block one we did the creative accounting and there was a point of recession as well. I hope you're revising your previous lectures. So let's get to the word file again, where we were discussing mostly the ICE 38 so far, right? And now we're getting back to the journal statement. Another journal statement is loan was negotiated. Loan was negotiated during the year. And there is an accounting treatment. Loan was negotiated. That means we got loan, and loan is part of financial statement. If the loan is part of the financial statement, should I be concerned about the disclosures of the loan? IFRS 7 financial liability. Should I be concerned about whether the disclosures have been given as per IFRS 7 financial liability? Because the loan was negotiated means it's part of the financial statement now. Should I be concerned about IFRS 7 disclosures? Yes. And should I be concerned about how the loan has been recorded as per IFRS 9? How the financial liability has been recognized as per IFRS 9? Should I be concerned about whether the loan has been recognized on the amortized cost basis? So should I be skeptical about IFRS 7 and IFRS 9 because loan is part of the financial statement? I am only getting yes answers from Khwaja Okasha. What about the rest of the class? When the loan has been taken, should I be concerned about the disclosures of the loan, whether they have been given or not? Should I be concerned about how the loan was recognized in the balance sheet as per IFRS 9? Okay, second yes answer, third yes answer, finally. So I have to pin you to get my yes and no answers. So as you are in the physical class, you are same in the online class. Yes, IFRS 9, right? IFRS 9 tells us how to record a financial liability. Yes, yes, agree, Faraz Hassan. P&L, amortized cost basis. So loan was negotiated can be part of an accounting treatment. Loan was negotiated can be a journal risk of an creative accounting. Okay, the voice has come back, right? So we were discussing the human resource paragraph. The review found that the company specified internal controls. The review found that the company specified internal controls in relation to processing of overtime payment and the tax payment were not always being followed. So is the examiner trying to tell us that the controls are weak, not in the whole company, but the controls are weak on the processing of the overtime payment and the tax payment? So is that very specific areas where controls are weak? Controls are not weak in the whole company, right? It is saying controls are weak on the overtime payment and the tax payment. So if I go back to my Word file, I am getting another journal statement. Another journal statement is that the controls are weak on the overtime payments and on the tax payment. Weak controls. Weak controls has nothing to do with an accounting treatment, right? Journal statements, right? Journal statements have no relevance with an accounting treatment. Now, just try to understand one thing. Controls are weak, not in the whole company. Controls are weak on the overtime payment and the tax payment, right? Okay, now understand one thing. I discussed with you yesterday, right, that the risk can be within the financial statement or the risk can be within an account balance. So let me demonstrate you one thing. Suppose it says internal controls are weak, and it says internal controls over processing of overtime payments and tax payments are weak. If I get the first statement in the exam paper when it says internal controls are weak, now the examiner is not telling me where are they weak. It is a very general statement. So my answer would be, if controls are weak, the financial statements could be materially misstated. Is that true? Because the examiner is not telling me where controls are weak. Examiner is telling me a very broad statement, internal controls are weak. So can I specify the account balance? Can I specify the account balance? Yes. No. The answer to my question is no, right? Rather, yes. Internal controls are weak. Do I know in which area are they weak? I'm not doing the question. I'm not doing the equation which is in the case, right? I'm not doing the equation which is in the case. I'm doing a journal equation currently, right? Internal controls are weak, full stop. Do I know where they are weak? So can we specify? No. So I'll say if controls are weak, the financial statements could be materially misstated. But the question I have in my June 13 paper is the second one. Let me highlight it with yellow. Internal controls are weak over the overtime payments and the tax payment. That is the equation I have in the June 13 paper. Now, has the examiner specified where the controls are weak in the June 13 exam? So my answer will be different now. If because the controls are weak over because the controls are weak on the overtime payments and the tax payment, thus the overtime payments could be fill in the blank and the tax payment could be fill in the blank. Suppose you're doing an F1 paper and you have a multiple choice question. In which fill in the blank you will write understatement and in which fill in the blank you will write overstatement. Because the controls are weak on the overtime payment and the tax payment, Thus the overtime OT, overtime payment could be, Khwaja, you will write under in both. Okay. So let's do a multiple choice question. One student is saying that he will write in both, fill in the blank under. Anyone else? Because the controls are weak on the overtime payment and the tax payment, the overtime payment could be understated in both. Yes, as OT, under expense, under profit. Yes, understated in both. Okay, so that means no one is reaching the maturity which you should have reached. There is a lacking of a common sense in the classroom. Overtime payment. Since when the overtime payment started to get understated? If you work in an organization, how can an overtime payment be understated? Overtime payments are claimed bogus. Overtime payments are claimed fictitious. Every employee like to get more overtime payments. Think about the self-interest. Think about the employee. Why will you understate the overtime payments? When the controls are weak, every employee will claim more overtime, right? True or false? When the controls are weak, every employee will claim more overtime or less overtime. Will the employee get benefit claiming more or less? So overtime payments, how can an overtime payment be understated? Overtime payments are overstated. In all organizations, every employee claim bogus overtime. Almost every employee claim bogus overtime. So all of you were saying under and under in both, fill in the blanks. Now see how your answer changed. Common sense, which is very uncommon. You have to exercise common sense. Okay, Faraz, I agree, you didn't. Common sense, which is very uncommon, even reaching P7 paper. So should I write the first fill in the blank overstatement? The overtime payments could be overstated. And the tax payment, you are living in Pakistan, so the tax payment has to be a very clear answer. Tax is a liability, tax is an expense. So tax should be under or over. Okay, the tax should be understated. So finally, all of you are on track now. See how I wrote the green point, internal controls are weak, and see how I wrote the blue point. In the green point, the examiner was not telling me in which area the controls are weak. But in the blue point, the examiner told me in which area the controls are weak. So is there a different way of writing the answer? In the green point, I wrote financials could be materially misstated. In the blue point, I wrote overtime payments could be overstated and the tax payment could be understated. Can you feel the difference of the two statements? And is everyone clear with that? So please be skeptical and please be realistic in the exam paper that how you write the impact. Not every impact could be financial statements are materially misstated. You need to specify the impact wherever possible. Okay, so finally we were on the second page of the case and we have read it. After that, it's written that until December 12th, processing was split between the human resource department and the finance department. Since then, the processing has been entirely carried out by the finance department. So is there a segregation of duty now? Read the last two lines and tell me, is there a segregation of duty or no? Is there a segregation of duty or no? No. It used to be, but currently they have removed it. So again, that means the controls are weak, right? Controls are weak over the processing of overtime payment and the tax payment. So the segregation of duty has been removed by the company. So that completes the paragraph on human resource. Now, when we were reading this question yesterday, there was a requirement on ethics for 7 marks. Remember? There was a requirement on ethics for 7 marks. Remember that B requirement. So far the case I have read with you. Have you found any single line about ethics in the whole case so far? Have you found a single line about ethics? No, because examiner has given you the last paragraph for ethics. So you will do the last paragraph yourself, because the last paragraph relates with ethics. So this is your duty now. You have to find 7 marks from the last paragraph. You will do this yourself, expansion plans. Okay, now we have done the reading and we found some points. Now I have to illustrate the points in terms of writing. So let's see the time we are left with, how many points I can draft. Is everyone clear? Expansion plan is your duty, right? So you will write the expansion plan because that relates with ethics and you have to find your 7 marks in ethics. Okay, let's go back to the Word file. Now in my Word file, when I have a new audit client, and I'm writing the risk, I think it's better I take you to my answer. New audit client. See, under the heading of the analytical procedures, where I had my 6 marks, now I'm putting the next heading. I hope you remember the logical flow of the answer yesterday. So I'm putting my second heading, which is audit risk. Now, what's the first audit risk? New audit client. We are doing a question on audit risk, right? So when the client is new, see what I'm writing. Parker is a new audit client for Hound Company. Therefore, the audit firm will have less knowledge of business, thereby increasing the detection risk in the first year of audit. So new audit client, detection risk in the first year of audit will be high. Everyone agrees with that? Because it's a new audit client and I'm attempting a question on audit risk. Audit risk includes detection risk. So if it is a new audit client, I will have less knowledge of the business, right? Thereby increasing the detection risk, right? That is 2 marks. Journal statement. Journal statements are so soothing in exam paper. 2 marks. Second, further, because it's a new client, further, there could be a risk of material misstatement in the opening balances. There could be a risk of material misstatement in the opening balances if the opening balances are wrongly brought forward by Parker management. See, a new audit client is also a detection risk, and a new audit client is also a risk of material misstatement in the opening balances. So see how beneficial this heading is. This heading is not giving me 2 marks. This heading is giving me 4 marks, because one risk is the detection risk and one risk is the risk of material misstatement. So this is also giving me 2 marks. When you're writing a journal statement, your drafting is very less, but when you're writing an accounting treatment, your drafting is more. So see, my journal statements are not vague. I'm putting a complete sentence for the examiner, and I'm telling examiner there is a detection risk, and then I'm telling examiner there is a risk of material misstatement in opening balances. So if you're doing a question where you have a new audit client and you think this is a question on audit risk, then the new audit client can give you how many marks? 4 marks, right? Okay, second, cost of sales. I'm going in the order, right? In the order we found the points. Cost of sales is the second point. Note number 1, cost of sales. The provision is wrongly classified. So that's the first risk we found, right? Provision is wrongly classified. That was the first risk in cost of sales, whereas it should have been classified under operating expenses. Thus, this must have distorted the gross profit margin. So the first risk is the wrong classification. So wrong classification gave me 2 marks. Then the second risk was under recorded. See my next point. The provision is under recorded by $200,000. The provision is under recorded by $200,000 as it should had been recorded by the okay, so the provision is under recorded, right? By how much? 200,000. So I should I should find the materiality of the under recorded amount. The under recorded amount is $200,000. So $200,000 divided by the profit is 30%. I think that is the operating profit, whereas it is 0.7% of the total assets. Thus, provision is material to profit only. Thus, at present, expense and current liability are understated and the profit is overstated. Thus, at present, the expense is understated and the profit is overstated. See, am I writing the misstatement? It is very important to write the misstatement. Thus, at present, the expense and the current liabilities are understated and the profit is overstated. You have to write the misstatement. You have to write the misstatement. See the drafting? Are you getting some track of writing the answer? We just discussed these points. Now it's about how to write them. But cost of sales is also giving me 4 marks. 2 marks for wrongly classified and 2 marks for under recorded, because under recorded is 1 risk and wrongly classified is 1 risk. So see, out of my 13 marks, under the 2 headings, I've taken 8 marks. You have to be very clever in P7 because there is so much opportunity, and if you take the opportunity, you can complete your answer so early. So see, I've just wrote 2 headings in the order of the case, and my 2 headings is giving me 8 marks. Is everyone clear till note 1, cost of sales? Okay, number 3. Development cost. The development cost of 2250, that was the value in the balance sheet, right? When you divide it by the profit, it is 3.38 times of the profit. I think the profit of the company is very low. The profit of the company is like just 690,000, if I'm not mistaken. The profit of the company is 890, sorry, the profit, operating profit, right? The operating profit is 890. And if I look at the development cost for 2250, right? So if I go back to my Word file, sorry, Word file, okay. The development cost is 2250 is 3.38 times of the profit and 8.2% of the total asset, right? This is the M, materiality. Thus, material to the total assets and material and pervasive to the profit. Just imagine for a minute that if the development cost should not be capitalized, will the profit converts to losses? Profit is only 890, and the development cost is 2250. For 1 minute think, What if the development cost should not be capitalized? Then your profit will get to losses. Is that something very, very important? It is 3.38 times of the profit. It is 3.38 times of the profit. So can the profit be converted to losses if the development cost should be expensed out? Is everyone getting the seriousness of this point? Yes. So the development cost should be capitalized. Now see, I'm writing the M ke baad T, the treatment. The development cost should be capitalized subject to a criteria given in I-38. So what I'm telling the examiner, that the development cost should only be capitalized when there is a criteria met. I should not start writing the journal criteria, which Sayyid Faraz Hassan was telling Pirate. I should not start writing the journal criteria. See what I've written after I-38. However, in the case of Parker, there are several risks associated with the criteria. So I'm linking the criteria with the case. I cannot write the generic criteria, rather I have to adapt the criteria to the case study. There is an economic recession. There is an economic recession, which will affect the company's ability to sell the new range of organic cosmetics. And moreover, cash flow is a problem for the company, which itself question whether sufficient resources are available to complete the ongoing development. See, I didn't wrote the journal conditions, rather I brought the condition of economic recession into my answer, and I brought the condition of the cash flow into my answer. Thus, because we're not sure, so I'm saying thus if the criteria is not met, intangible assets could be overstated and expense are understated. See, have I followed the approach of MTR? I wrote the materiality, then I wrote the treatment, but the treatment was not generic. The treatment was very specific to the case. And then I wrote the risk, over and understatement. Are you getting the track of the drafting? Okay, now do one thing. When we have a physical class on Monday, the next 3 classes are very important, because the next 3 classes will be wrapping up risk, all the risk, business risk, ROMM and business risk. I'm giving you something to read over the next class, for the next class on Monday, where we have plenty of time. Firstly, I'll share this answer with you. Read this answer so that you have some temperament of how to write an answer. So I'll share the PDF file of this answer with you. If not today, maximum by tomorrow morning, you will get the PDF file of this answer. So at least you have the June 13 answer with you. Now June 13 has been done. That means discussion, and I'll put half an hour of that in the class on Monday. You are preparing 2 questions for Monday class. One is June 15 question number 1, that is on audit risk. June 15 question number 1, please note it down. And December 15 question number 1. December 15 question number 1. June 15 question number 1. December 15 question number 1. Right? June 15 and December 15, both question 1. Right? Both are on audit risk. That means risk of material misstatement. Now what you will do, you will do the same thing, the one I did with you in the session. You will think about what are journal statements in the case. I still need to give you a good lecture on journal statements, okay, how journal statements can be a stress reliever in the exam hall, but I need to have a physical interaction with you in the class on Monday on that. Accounting treatments, when you're reading the case, you need to find out the accounting treatments, and you have to be negative on accounting treatments. I hope when you're reading the June 15 exam and the December 15 exam, you will find out the accounting treatment, and you have to be negative finding the risk in the accounting treatment. Numbers can be somewhere, if you found an implausible relationship, you will utilize the number. But I'll try polishing this topic in the Monday class when I meet you physically, because a lot of things needs a physical interaction. So probably the first half an hour of the class on Monday will be very important, because it will be the polishing of this June 13 exam paper. And then in the same class on Monday, we'll do the June 15 exam. And probably once you understand the June 13 and June 15, you will take December 15 as your assignment. And I'll start business risk on Tuesday. Okay, so study the block 3 wherever we are. Whatever has been discussed in the class on Monday, Tuesday, Wednesday, please do that. There was an article, Planning and Audit of Financial Statement, which was recommended to you on Monday. Please ensure all the 3 classes been done this week. You have revised them. There is no backlog. I'll share the link of the Monday class, Tuesday class, Wednesday class by tomorrow. And I'll share my Word file with you tomorrow as well. So by Monday, you have no excuses that we didn't got the link, or you have no excuses that we didn't got the Word file. So by tomorrow, you will get everything. Spend time on it so that Monday, Tuesday, Wednesday, we can complete the maximum part of the block 3. We can complete the maximum part of the block 3. And hopefully, I think as we are going currently, I try my best that we complete things by, we have a class on 23rd, 24th, 25th. Then we have a class on 30th, 1st and 2nd. So that means we have 6 more classes till 2nd of May. Then we have a class on 7th, 8th, 9th. I try my best to complete things by 9th of May, because that is the Wednesday. But I have to increase the timings of the class. If I have to finish things by 9th of May, at least effectively we'll get 1 month to prepare. So tentatively, I'm planning that 9th of May we are done. I'll try adding some classes, not adding some classes, increasing the timings of the classes. Right? So, okay, that's fine. That's fine. Okay, please study. I try my best. From Monday onwards, we'll pace up things, and hopefully by 8th and 9th of May, we should wrap up things. I might increase the class timings from Monday, and somewhere in the next week or the week after, I might even call you for 1 class on Sunday. I hope Sunday is not an issue with anyone. All of you can come on Sunday morning whenever I announce it. Right? So if I call you on any Sunday morning, can you come on Sunday morning? Has all of you left? Getting no replies from anyone. Is everyone there? I'm asking a question to everyone. If I call you on Sunday morning, not this Sunday morning coming, but whenever I call you on Sunday morning, are all of you are available on Sunday morning? Okay, so please revise whatever we have done in the class today. I'll meet you physically in the class on Monday. Allah Hafiz.